Welcome back to Good Returns. I'm Matt here with Garrett, and 6 consecutive weeks of gains. The NASDAQ up another 4% this week, and a planning room topic today that I genuinely think everyone listening that's ever even heard of an annuity needs to hear.
Strong teas.
Yes, it is. Yes, it is. And I mean it. And we'll get there. First, as always, quick reminder that everything on Good Returns is for what we call educational purposes only. Nothing we say should be construed as personalized financial advice for your situation. We are here to help you think more clearly, ask better questions. And if you have a question about your specific situation, feel free to reach out to a trusted advisor or go to momentumwealth.us.
Well said. All right, let's get into it. Like you said, 6 consecutive weeks of gains. S&P 500 up 2% on the week. NASDAQ up 4%. Small caps up about 1.5%, hitting a new all-time high of their own. And kind of worth noting because small cap participation has been kind of a question mark for the past few weeks. We had a really strong run up and then it kind of tapered off. 3 of the 4 major indexes are at new highs. I feel like that's a recurring theme that we've been talking about the past few shows. New highs, new highs, new highs, new highs.
Yeah, we're seeing some very interesting things. The breadth picture, the extent, the how deep and wide the participants in the index are moving. It's still a little mixed. 6 of 11 sectors finished the week lower. Tech, consumer discretionary, communication services led the way. But the small cap new high is a constructive signal. It appears that the rally is beginning to broaden a little bit.
Yeah, you definitely want to see that. We can go back and check here in real time. Let's see what the equal weight is doing. Equal weight year to date, we're up 6.6%. We got the market cap weighted SPY up 8.11%. So we are starting to see the S&P 500 cap weighted taking over the equal weighted index.
Yeah, which is to be expected with the type of pullback we had, and then a recovery. Generally, your market cap's going to lead.
Also the type of recovery, because you've had a lot of, and we'll get into it in a minute, you've had a lot of the big names pushing the index up because they are tech companies, but they are a very large part of the S&P as well.
Correct.
So to be expected.
Yep.
Yeah, all good things though. Bonds, we had producing modest gains. Oil fell about 8% on the week, trading near $90 a barrel at one point. Again, we have reports of progress toward a framework to end the conflict. You know, another kind of story that we have been talking about for a long time.
Yeah, we'll see. Definitely see how that plays out here. Probably could be within the podcast. So we'll see, maybe can get some real-time reactions on commodity prices and kind of see how the market's responding to some of the real-time headlines. Most of the week's equity gains came in a single session after those reports surfaced. The pattern we've seen basically for 10 weeks, kind of headlines leading that. Market kind of sitting still, waiting for headlines to drop, and then a move in either direction. So definitely some things to watch closely.
Yeah, we'll be looking at oil too, as we always are. The closer we get to a resolution on that, I think the general consensus is sort of what you've said for a while, which is that the longer term trend is down on oil. I think a lot of companies in their earnings call have made kind of have alluded to that. So I think that everybody's sort of expecting that.
Yeah, and if we look back on the week, we're kind of 10 weeks in. To the conflict, it did see a pretty encouraging diplomatic signal. Kind of this last week was probably the most encouraging if you're using the market to interpret it. The week opened initially on a difficult note, strikes on the UAE. You had some commercial ships that were attacked, and even, I guess, over the night, some rumors of escalation. It's kind of the fog of war. Nobody really knows until time passes. But definitely, again, looking at the developments through the lens of the market, this week was seemingly the most encouraging.
Yeah, I mean, you have some allies, especially in the region, pushing for de-escalation. I mean, there's a lot of people that thinks that it's gone on, long enough and something needs to happen. So I think they're pushing both sides to do that. So we'll see how that plays out.
Yeah. We had a big drop again this week. It's kind of been a joke around here that oil is trading like a like a meme stock or a meme coin, so to speak, a giant drop in one day, and then you had a little bit of clawback, then another drop. So would not want to be an oil commodity trader with all this, because that's got to be some rough rides for sure. The honest caveat, we've seen headlines before that's kind of driven the market. I guess the difference would be how the market's treating what they would call a framework, which makes one believe specific terms on the table by both sides. So whether it becomes an actual agreement, it's really the question, but the direction definitely is the most constructive as the market views it, as it has been in the last 10 weeks.
Yeah. There's not much else to say about that. I mean, it's sort of beating a dead horse at this point, but oil is just kind of something we're watching. I do want to go back to the first section. What we should have added to that, in addition to the indexes, was the movement of Bitcoin, because we have seen some constructive things there. You have seen, if you look at an ETF, let's see, the Grayscale ETF is up almost 13% over the past 30 days. So, I mean, you are seeing some movement there. For us, that's a positive sign, a constructive sign. A lot of people have gotten some positive signals there. So that's something we're watching as well. A lot of people may not have exposure to crypto or digital assets or Bitcoin. Should they, shouldn't they? It's kind of, it's a specific question for a specific situation and a specific person. But it is, in our view, a part of diversification, just like international assets or commodities or anything like that would be.
The vast overwhelming majority of our clients have exposure to Bitcoin and Ethereum and have had it for some time. They had it before ETFs. So you can imagine some of the embedded gains, depending on when rebalances took effect and each client's kind of individual situation. So if, blanket recommendations generally aren't used, right? But but to get points across, they are. So, for instance, if you want to grow your wealth in the market, you have to have exposure to the markets, the risk assets, right? You have to. There's a universe where you don't, right? So that's a blanket statement. And I could take it a step further when concerning crypto. If you want the potential for your portfolio to punch above its weight class, you have to consider what these new asset classes mean for you, because it gives you a significant opportunity. And we are seeing some extremely positive developments, both from the technical price movements of the major players in the crypto space, which is going to be Bitcoin and Ethereum, but also from a regulatory perspective, the Clarity Act appears to be on a fast track to be passed. And that's a big deal. And so we at a later date, and maybe when that passes, we can have more of a special segment on the show dedicated to it as far as to what it means, and especially for people that may be new to the concept of what is cryptocurrency, what are blockchains, and what's the value in them. Once that Clarity Act passes, we could do a deep dive into it, but it's very interesting. It's very substantial. It's definitely a new sector of the economy and of the markets that has it's not even potential, it's the reality. It has just as much of an economic disruptive effect on productivity and wealth creation that artificial intelligence does. So we're seeing some very positive developments in that. And it's a very exciting asset class. We need to dedicate a little bit of time to it. But yes, last month was kind of a step change in bull bear expectations for that space for sure.
Yeah, we'll see if it holds up. I mean, I would hope that it does. But that's one of the things you have to watch to make sure it's not a head fake, so to speak.
Yeah.
So we had something similar happen in January where you had it kind of pump up, and then we're still in sort of a drawdown. I mean, it's but definitely beneath its highs. So we haven't recaptured that as far as that specific sector is concerned.
Yeah.
But we're on the way to do that, I think.
Yeah, I think so. Looking at earnings not really earnings as much as CapEx, the spending disclosed in earnings.
I mean,
reports,
it was reported in the earnings.
Yeah, the earnings for artificial intelligence. Again, we want to underscore how much money is being spent this year. You want to think COVID level stimulus money that these private companies are spending on artificial intelligence. Alphabet, Amazon, Meta, Microsoft, All reported over the last 2 weeks, all beat estimates, strong results across the board. But the number getting the attention is not the revenue or the profit. It is how much money they're spending.
Yeah, also known as CapEx, capital expenditures. You have the 4 largest U.S. cloud providers. Combined infrastructure spend for 2026 is over $660 billion. We just let it sit for a moment, just sit with that number, $660 billion. And this is sort of the reason for, the growth here, the earnings growth. There's a lot of expectations on these companies. And this is what we talked about last week, which is that earnings in and of themselves are not necessarily what is going to drive a stock price forward. Look at yesterday, we had earnings released for SoundHound. Their revenue is up 50% year over year, and the stock price is down 12%. So it's not that's not an end all be all. Like if a company beats earnings or beats revenue guidance or whatever, it's going to go up. That's not always a sign of it. But we are looking, another big thing we're looking at is the spending that these companies will do and whether or not those forecasts remain through the rest of the year or if we get a change in the fourth quarter or something like that.
Yeah, it's SoundHound's interesting. The company has an interesting investment thesis. It's built around how people are going to communicate with anything artificially intelligent driven. How are they going to communicate to the robots? How they communicate to order food? Because you want to have a conversation. You know how irritating it is with Siri or Alexa, right?
I don't have Alexa, but I know that Siri is
it's irritating. So you want to be able to have that free flow. And so, you're seeing the market's having these wild, disparate reactions to companies. Either they think are spending too much or they're making a lot, but they're reinvesting too much. And it's a very interesting time to kind of go through these earnings. But I'll just say on the $660 billion, it appears that, I think there's 187 countries in the world. I think only, and I could be wrong on this, but I do believe that only about 12 of them have a GDP greater than that, meaning that just those handful of companies in the U.S. are spending more money than the GDP of around 170 countries.
Yeah, it's a big deal.
Yeah.
But,
not combined, obviously, not 170 countries combined, but out of any one of them.
Yeah, I mean, looking at the numbers, it's staggering. Those are staggering numbers. But if you look at the earnings, if you look at the revenue growth, they're all strong. They are legitimately there, as far as we can tell, with these companies disclosing their information. And a lot of them have backlog too. Like with these cloud providers or infrastructure providers, you're seeing this week, Anthropic, which runs the Claude AI models, are partnering with SpaceX for more compute power. Because if you have used Claude, which we do here internally, it's very frustrating when you're working with it and then you get kind of a roadblock where it won't work or it hangs up or you have to retry or refresh because it's just being hit so hard, the infrastructure. So they have to find some way to support this because you can have the best AI on the face of the planet, but if it doesn't work, then it doesn't work.
Yes, and that's where software land interacts with hardware land. People had always, thought, are we ever going to have another industrial revolution where you have this physical infrastructure, you can see it with your eyes, things changing in construction jobs and physical interactions with new facilities. It is absolutely happening, and it's because you have to have the hardware in order for the software to work.
Right.
I mean, it's common sense, but when you think about just in the last 3 years, the demand for compute power alone has gone up 1,000 times. That you have to have the hardware for that. You have to have the fiber. You have to have the Ethernet. You have to have the copper. You have to have the chips. You have to have the facilities. You have to have the air conditioning, et cetera, the plumbing, the electrical. It's quite interesting.
Even at a consumer level, the people that are using, there was this wide buying spree. I think you were involved in it too, but of the Mac Minis, the Apple Mac Minis, and their base model, which was like $599, doesn't even exist anymore.
Yes,
they got rid of it completely. Like the entry level is now $700 or $800.
Yeah, I just got the second one in. It took a month.
They can't keep up with the production of them.
Yeah, maybe I should resell them on eBay. So the money that's going out, it's building the physical infrastructure, the tools that can handle the task and workflows that businesses currently use software to manage, enterprise software specifically. So, that does show you if the demand is there for the products, enough for them to spend more than $500 billion, almost $750 billion this year alone, then that tells you there is an insatiable appetite for companies to replace something that they're currently using that they believe is more efficient and will save them money. That's where enterprise software comes in. And, think of thousands of software companies sell that product currently being used that's probably going to be replaced in their entire workflows. And AI is gunning for every bit of it.
Yeah, and it could have downstream effects. You have these large companies spending an ungodly amount of money. It's really hard to fathom to replace, like you said, an entire industry, which has historically been a really good place to invest. And you've seen a lot of companies move to that sort of investment because you think about everybody wanted to up their services offerings, their subscription services, because if they get you on that $10, $15 a month or whatever, it's very highly likely that you're not going to leave. I've been paying for Netflix since it was $7 a month, like decades ago at this point. And now I got a recent price increase email like a month ago that it's going up to like 20 or $25 a month. I mean, it's crazy. And so you see historically that this was a good way, because if you up my price $1, I'm not likely to do anything because you have a user base, a huge user base. You're raising everybody's price $1. So you can get more revenue that way. And it was historically a good place to invest. And you saw a lot of investment go into that. Recurring revenue, high margins, sticky customers, all of that. Private equity has been a decade loading up on these software companies for exactly those reasons. The question is whether that's going to be a successful strategy going forward, or what it means for companies that are highly invested in that.
Yeah, we're going to get into it for sure. We'll come back to that in the planning room. It's got implications. We talk about first, second, third order effects. We're about to lay it on you today.
Yeah, but I think it's not meant to be. I mean, it is meant to be an eye-opening thing. It's not meant to be like a gloom and doom type thing, but it is something that is not widely being talked about that probably should be talked about more. But again,
the Fed, we did have a meeting. No shocker there. They held rates steady as expected. Divided vote.
Yep. Very divided vote. So we had 4 dissenters this time for pausing on the rate cuts. So, what does that mean? It's certainly not a unified institution. It's just going back to the conversation we've had in the past few weeks about what the transition of Powell from chair to just on the board means. Like he's going to be a presence there. If I don't even think that those dissenters didn't even want to cut. I mean, they're not, like, their dissent is across the board, which is really interesting to see. And I think a lot of them have these concerns about the Middle East developments and the oil and all that kind of stuff going into that. And then you've got other members that are like, no, that's not going to be a.
I think it's moving. I think it's moving because the way the dissent and the votes for versus against is really kind of they're turning into more of a show me Federal Reserve. I think that's really. I think the bias to ease is probably in the majority, but I think that they're at a place because of Fed credibility. We've talked about this before. They're in a place and kind of show me the productivity. So they're going to get there. And once the commodity disruption that the world has been experiencing goes away, that's really going to kind of remove the last bit of caution before they move purely into that show me the productivity. And I think that they'll be able to see it pretty quickly. This is not going to be, because it's already happening. The productivity boom driven by artificial intelligence, along with other technological advancements, is showing up now. And it's these moves do not happen in a slow linear fashion. It is logarithmic. And so I believe they will see it, and the trajectory is going to be down, probably closer to that 2% mark. So that's if you cut a quarter point at a time, is that 8 cuts, 7 cuts?
Well, it depends on when it starts, because you've only have one vote for an immediate cut. So I mean, if your argument is that a lot of them want to cut, I don't know why you would only see one of them saying that. And does it have to do with the paradigm shift that's about to happen? I don't know. And when Warsh gets in there, obviously he does want rates lower, but is he going to be able to immediately start the cuts, or is he also going to be more cautious? That's the thing that we don't know.
I think the markets really are paying more attention to the direction than how fast. Because right now there's really...
Yeah, but they're not pricing... We're not pricing any cuts in.
Yeah, for the rest of the year. One thing that's definitely going to change with the new Fed chair is less public speak. So there's going to be less of all of that. What do we think is going to happen? Where's the dot plot? That stuff's going to be really clawed back to the way it was decades ago. And you can mark that down. That will happen.
Mark it down. Do you think, though, that the market will, once Warsh is finally confirmed and in the position, do you think we will see the market respond to that in a negative way, at least in the short term? Because that seems to be the thing that happens when we get a new Federal Reserve chairman, is we do get a slight pullback in the market. And I don't know if it seems highly related to that. It's very correlated to it, but I don't know if that's, I don't know if there's a situation where that can't, or that doesn't happen. So it's an interesting thing to look at. He's going to be confirmed at the end of this month. Is that right? I mean, he's going to take the job next month is his first. Is it at the end of the month?
It's sometime this month, I think, towards the end of the month.
So the question is, how do the markets respond to that?
Yeah.
I mean, we've had a long time to digest it, so I don't know that.
I don't think they care really, because his bias is to the downside based upon productivity. We've said that before, kind of beating a dead horse. But I think it's more like Greenspan and less like a reactive Bernanke or a reactive Powell to a crisis where it's like boom. I don't think that's going to happen. It is going to be, Greenspan's major easing cycle took place over 36 months, and that's the market will begin to price that in. Perpetual. And there's an argument to be made that a general framework and understanding that we're going to get to that 2% rate most likely, but it's going to be done over a period of time. That's really all the market needs. Is just to predict out and have that slow progressive kind of show me approach. Okay, is the productivity occurring? All right, we'll cut. Is the productivity occurring? We'll cut. Because you have to protect the labor market and the consumers throughout that transition. So it will be very interesting to watch. I predict market is kind of a nothing burger with it. But it does show us that, again, it's not a monolithic institution. They have real disagreements happening in real time. But I do believe our knowledge of those disagreements is going to begin to become much, much more opaque, because that is one thing they have said is going to be changing pretty significantly, is how much these Fed governors and people get to speak and move markets with their opinion that is their opinion, but it's not the data-driven approach that they actually operate by. So I think that's probably going to change, and we'll have a lot less to talk about with the Federal Reserve until they actually do it, which historically was the way the Fed operated. And so the markets did just fine with that. So there's an argument to be made that...
I don't know about that, though, because Powell was also a Trump pick, but you have Warsh coming in as Trump's pick, and it's like the conversation I think will be interesting, because I think that you're going to see a lot of people, a lot of headlines blaming Warsh for kind of kowtowing to Trump in a way that you didn't necessarily see and not to the good part or the bad part, not to either way. I don't have any point on that, but just in a way that Powell didn't necessarily do. And for whatever reason, he's got his own reasons, but that will be the interesting part of the conversation. Like, if the rates need to fall, like in an environment where they need to fall, and he makes a point of getting there even gradually, what is the reaction to that going to be? That's what I think will be interesting. And it may not matter.
There's never been a president in history that has not wanted the Fed to cut rates. So I think it just really comes down to that. Every president wants ultimately wants rates lower, because it people don't like paying high interest, right? So I don't know how much the political nature of all that. At the end of the day, these are 10-year terms, and they'll manage through. But I believe that
it's a long time for a Federal Reserve chairman.
Yeah, it is. Years. But I think that I think it's an appropriate time for a change, simply because, wanting the country to do well during this technological shift, this paradigm shift that we're entering into. It's good to have somebody that is talking about the real world realities on the ground about changes happening with job losses to AI and what that productivity means, and how interest rate policies should adapt to that, because it is the most ground shaking transformation that has happened since the invention of kind of the simultaneous invention of widespread electrical use, telephone communications, cars, and airplanes. All happened within like a 30-year period of time, 100 years ago. This is equal to, if not greater than that. And so that has real profound.
Well, I also think that, because you're right, the Federal Reserve has the dual mandate that we've talked about before, which is employment and price stability. But if you're looking at it from the standpoint of the vast amount of hiring that went on specifically in the technology sector over the past 5 or 6 years, maybe more than that, 6 to 7 years, I mean, there was a lot of hiring that went on. Some of these companies hired an enormous amount of people. Like, we had a discussion about eBay the other day. They have a lot of employees.
11,500 people work for eBay.
Yeah. So maybe this AI, job displacement for anybody is hard. It's difficult, and we're never a fan of it. But is this an introduction of like a norm? Is it normalizing the employment levels at these companies that were outsized before this? Did we just live through a period of time that was just kind of abnormal for how many employees these companies had, and now they're getting to a place where they have to realize, hey, we got to get back to some normalcy? Like, is that a part of the conversation?
I mean, you always have cycles when you think of eBay, disruptive company. They then become an established, entrenched player. Generally, that leads to budget gluts, inefficiencies. That's part of a life cycle of some companies. But the reality is, I can set up this afternoon, give me 2 hours, and I can set up a competitor to eBay with 4 AI bots.
Yeah, I mean, in theory, yeah, but you wouldn't have the reach or the power or the capacity that they have.
No, but then when you look at, for instance,
it's not I'm not saying that that's the shining example of an e-commerce. I think the whole, if you're following this Ryan Cohen through line where GameStop is trying to purchase eBay, he's got a lot of points about how poorly run the company is. But I mean, I think that it is what it is. It's a place where most people go. So discoverability would be a good factor too, because you can build the platform with AI, but the discoverability part of it, you're likely not going to have many users.
No, but if for instance, if Ryan Cohen let's say this merger doesn't go through and he just wants to make a competitor, he could drop $100 million and do it easily.
Yeah.
Very, very easily.
But there's a reason that he doesn't want to go that route.
Well, no, and that's true. But at the end of the day, regardless of mergers or buyouts, when you have a fiduciary responsibility, a legal fiduciary responsibility to your shareholders, and you're running a company that has no assets, that owns no products, but you have 11,500 people running what is essentially a website with, a very limited technological advancement. With artificial intelligence coming in and making things so obviously more efficient, there's a gravitational pull for layoffs to happen. And that is the unfortunate and uncomfortable reality that we're walking into with software companies, with companies like eBay, with companies like Etsy, that experienced tremendous growth, and then they hired and they scaled, and they have probably wonderful team cultures and probably a great place to work. But there is a giant, insatiably hungry monster on the horizon that is coming to eat these jobs up, and the economy has to be prepared for that.
You ever see these videos of these people that work at
Which
Amazon?
is where I think, well, just real quick, I'll just say
go
real quick,
ahead.
just this is where I think it, and it's not going to be this year and it's not going to be next year, but wholeheartedly 100%. And this is the thing about being a long-term investor and thinking about the future and possibilities and how things are going to shift and change. It's always great thought exercises to do that. But this is where universal basic income will 100% happen. I've been probably for about 3 years, I was convinced that that is 100% going to happen. There's really no other option that is out there because of some of the things we're going to talk about and some of the drastic changes that these productivity gains and these gains in efficiency are going to bring about. So it's something that will probably be a big tailwind, a positive thing for markets, because of we are a consumer economy. And if that consumption stops, we got ourselves a problem. And so the more structural changes that go to constantly strengthen the consumer is going to have pretty significantly large upward impacts on the market and in the markets in general. But let's get into, what were you saying?
It's just neither here nor there. I was just saying, have you ever seen these videos that people record of themselves, like working at Meta or Google or Amazon or any of these large companies where the day in their life or whatever, they'll film walking into the office at 9 or 10 o'clock, sitting down for an hour-long breakfast, going to a meeting, then go into lunch for 2 hours. And like, it's all of this stuff is visible now that we have an insight into, these companies that, may want their employees to have their phone on them and like show what they're doing. But I think that by and large, you take an 2-hour lunch and then you go to one meeting and then you go to like the on-site masseuse or something like that. I mean, this is a different culture than people are used to. And so a lot of people are looking at that and saying, yeah, it looks like you're going to have to cut some people. I mean, Google a few years ago, I think let go of all their massage therapists or something that they had on. So it's like, this has slowly been happening.
That's true too. And there is another side to the argument. Again, when we think about like structural changes, I'm pretty solidly convinced now, other big tech guys call it universal high income, or other people will call it whatever. I'm pretty well convinced on that. But I think that as far as the fact that it's going to happen, it's just a reality. But, less convincing is like how significant the changes are going to be, because the argument could be made that those companies are able to allow their engineers to have that flexibility and that freedom and that work-life balance because of how productive they are, and AI could just supercharge that, meaning that they may not hire as much, but their army of workers can now become like 10 times more productive, making the company 10 times bigger. So there's another side to that too that I guess we should speak to, and we obviously can't predict. But in all of this and in all of these questions that just, again, through curiosity, they naturally pop up in your head, and you can try to sit one evening and try to figure it out. And you hear these words like the SaaS apocalypse as we transition to the planning room now. There's a term that started getting into our vernacular back in October called the SaaS, which is SaaS, software as a service, the SaaS apocalypse. And it's where a lot of the improvements on the large language models and companies like Cursor that have coding agents was creating significant disruption in replacing enterprise software. So when you think of enterprise software, think of companies, for instance, for us, how we manage so many hundreds of clients is to have them in a database. And then that database allows you to do all kinds of things and automate different outreach, keep tabs of to-do list. The sky's the limit. And that software is an enterprise software, and it has the ability to, like you were saying, of $3,000 a year, and now next year it's $3,500 a year. Where you're going to pay it because you're addicted to it. It's low cost relative to what it's doing for you, and they kind of got you with these sticky products. Well, a lot of these enterprise softwares can easily be replaced by somebody creating a free replication of that software one time, and it saves the company $1 million a year in these subscription fees. So let's talk about that.
Well, I think that there's a scenario here. We have to divide this, because when you're a smaller company like we are, we can pivot much quicker than larger organizations that may have other things to consider, regulatory concerns, security concerns, all this kind of stuff that they have to, which we have those too. Don't get me wrong, we do have those, but we're able to pivot much quicker into different environments than a large company would be. So, I think there are, when we're talking about this, I think there are services, and I don't, obviously we're not going to sit here and list companies, but I think there are companies and sectors of this service.
Want to bet? I'm just kidding.
Of this service industry that are more at risk than others. So
Yes.
there are software companies that will either be able to pivot, or maybe they are like so niche enough that they're going to maintain the majority of their user base. But there are other softwares that legitimately are not built on anything proprietary, and they're not they're not necessarily something that can't be replicated, like you were saying. And they are in real danger of maybe not going out of business altogether. Some of them will, but certainly having much lower revenue, which is what investors care about, and which, what affects their bottom line directly. And so we talked a little bit about earlier the private equity companies taking positions in the software companies because the revenue story is really good, and it has been for a long time. This is the part of the economy that was growing. This is the part of the balance sheets that are growing. The software as a service. Everybody's transitioning from you don't pay one time for your software. Now you pay $9.99 a month for your software instead of buying it for $200 or whatever it is. And lots of companies liked that. Lots of private equity companies liked to invest in that because it was a surefire way to get revenue reliably. And so the question is that going to continue now that AI is building sort of a replacement layer for it, for a lot of the software at least?
Yes. And so why would we be talking about this? When you think of software as a service and you think of these companies that have these sticky subscription models, high margins, it does look like a safe, reliable investment. But like you said, the disruption is real. And it's being funded aggressively with the $600 billion build out. And we're going to see this play out over the next, few years. And as you said, some companies will survive, some won't. There are some great software companies that I pay attention to that are going to probably dominate as a result of AI. That's the exception, not the rule. Mm-hmm. So as we're talking about this, it does sound like a tech stock story. So why would it be in our planning room? Why would a regular investor who doesn't own software stocks or doesn't have private equity in smaller software stocks, why would they care?
Well, because of private equity, that's the whole conversation. Because of private equity and really because of annuities. This is the big one. And this is the thing that's not getting a lot of airtime. It probably should be getting a lot of airtime because there are a lot of people that have annuity products. And that can mean a bunch of different things.
So what does AI disruption have to do with what generally is sold as a conservative alternative to certificates of deposits for retirement income or tax-deferred growth products, also known as annuities?
So they're not always conservative. We have different levels of annuities. You can have really conservative kind of CD level annuities. You can have ones that are tied to a certain index, and you can have ones that are market-based. And so over the past decade, you have private equity making a massive bet on the software for all the reasons we just listed. They love predictable cash flows, which software has been thus far. So these private equity firms went out and bought these software companies by the hundreds, by the thousands, often at high valuations, often using a lot of debt to do it.
Yes. And so before we dive a little bit deeper, I do want to give a disclosure. You have to understand, and I'm sure those that are listening do, insurance companies are a dime a dozen. They are not all created equal. So what we're about to talk about is about specific, we won't give names. That can be done with a phone call to us or an email, and we'd be more than happy to discuss the names and the details of what our research has uncovered, but we're not going to give names. But just know that, we have several clients that because of where they're at in life, their risk tolerance, certain fiduciary management fee-based annuities are a good fit for them. That requires research and understanding of the product and the company that is backing that product. So, this is not, before we try to get a lawsuit by an insurance company, this is not all of them. This is the most prolifically marketed ones that think of commonly seen ones from brokers. Let's just say that, but just keep in mind, if you have a question, we can dive into the balance sheet and uncover if that annuity provider has exposure, which we have done. We have experience doing it. You just have to know where to look. And so that's the due diligence that we do on our end when we're looking at whether or not a client or whether or not somebody bringing us an annuity and maybe wants to switch to an investment account of some sort or stay in that universe. We want to do a deep dive and understand what's on that insurance company's balance sheet. So with that out of the way, let's look at the debt that you're speaking about. So, and I'll just restate it. Private equity companies lend to software companies that are not public. The reason they do that is there is a lot of upfront cost to create the software, but once it's created, the margins are 80, 90%. Call it an infinite ability for margin expansion, okay? Because all the cost is done, and it's just the only variable or marginal cost on top of that is simply going to be your AWS fees or improvements in the software over time. And that's minuscule, tiny compared to the subscription value. And so once a company funds it, they create it, they start getting market share, they want to take on debt, not sell their equity, because they know, hey, if we buy up smaller companies or we continue to scale at the rate we're growing, we're going to be able to get a much bigger multiple 5 years from now when we sell out or go public, and we don't have to give up our equity because our equity is going to be worth, 10, 20, 30, 40x what it is today. So they'll take on debt. Private equity loves to lend to them because the margins are so high. They have a predictable growth rate. And it's like once you find the trade winds, your ship's going to sail in this direction. It's been a proven business model since 2008 when a lot of these companies, replaced mortgage-backed debt with PE level software debt for these private equity groups. And so private equity would fund whatever expansion or whatever acquisition a software company needs funded. And instead of taking that debt to the market and sourcing it through investors, they figured out, hey, we could just buy up an insurance company and then offload the debt, with a nice commission to the parent company and to the partners of the PE firm. We can offload the debt onto the insurance company's balance sheet and crowdfund all of this operation through conservative annuity investors. Continue.
Yeah, and the insurance companies, of course, liked it because the returns have been really good, and it's allowed them in pension plans and things like that they have obligations to meet. It's allowed them to meet those obligations.
Or when you get sold an annuity and it's like, hey, you get a 10% bonus, and then you're going to get 10% the first 2 years, and then you get all these other percentage points, and they just like, just all these bells and whistles get vomited out at you. Well, it's because of, in large part, it's because of the interest rates they were getting from these software companies. Now, as you were saying, when a private equity or a private debt funding company gives them that money, that debt has to be serviced, right? Mm-hmm. And then the software company still has to.
Yeah, it has to be serviced.
Has to pay out.
So that the software company generates the revenue, the service, the debt. The private equity firm manages until it can sell or take it public, like you were saying. Mm-hmm. And as long as that keeps working, as long as people keep paying the subscription fees, everything goes well. And there's no real alarm bells ringing.
So if then somebody at, say, I don't know, let's use Coca-Cola. Let's use Coca-Cola.
Not a SAS.
This episode of the Momentum Podcast brought to you by Coca-Cola. It's a joke. So let's say Coca-Cola has a inter-office team reminder and communication product that they have purchased a subscription for, say, $10 million a year for their companies to AOL instant message each other about distribution channels or whatever it is people at Coca-Cola talk about, the secret ingredients, whatever. And they realize $10 million a year, good God Almighty, we could pay a few of our engineers and using these AI tools that are available to us, and probably for $500,000 a year, have this and have it better. Well, they have a fiduciary responsibility to do that. So they say, hey, we're going to save $9.5 million a year. They cut it. Now we have a problem because that software company that was providing that, again, for an example, that custom version of an AOL instant messenger to be used inter-office is no longer getting that $10 million a year. That's not just $10 million a year in revenue loss. That is potentially a halving of the value of that software company when they lose that big customer. Now their debt becomes not a great source of revenue and a highly rated, predictable cash cow. It's an all or nothing game. That debt is now worth nothing. And that presents us a problem because insurance companies are among the largest buyers of this private credit and corporate debt in the world. They generate the returns they need to back the products they sell, including annuities. So we have ourselves an issue if that debt gets downgraded. It's just like mortgage debt. It's either all or nothing. There is no sliding scale. It is either AAA or it is junk. When you get to software debt, that's the reality of the world. There's no like, maybe they will, maybe they won't. If they don't have the customers, they're not paying you. It's like if you don't have a job, you're not going to pay your mortgage. I mean, it just is what it is. There is no middle ground.
Yeah.
It's like maybe I pay you half.
Well, I think a lot of people feel confident in, to be careful of how I say this, like confident in the debt levels because of the ratings. And in all reality, those ratings are very backward looking. They're going to tell you how the debt has been viewed so far. They're not necessarily going to tell you how the debt is going to be viewed in the future. And I think, not to go back to 2008, but 2008 was a good example of that because that's what you saw in the mortgages, where you had these packaged mortgage products that were AAA rated, but they were actually full of junk bonds, like the worthless stuff. And so this is the same kind of, it's not the same. I don't want to like make a direct comparison of that, but it is similar in that it's hard to know what's going to happen in the future with debt ratings because they are very much backward looking.
Well, yes, and if you have 80% perfect mortgages and 20% subprime and those 20% default, you have junk debt. You just do.
Yeah.
And that's a problem because lots of things are tied to that. So when many people, if they're doing their due diligence when they're looking at annuity companies and they're saying, well, hey, this particular company is an A or AA, rated insurance company. Well, they have been heretofore, but as you said, the rating's backward looking. It doesn't necessarily reflect the what ifs.
Right.
What if?
The big what if that we're talking about now. I mean, if we look at annuities, the very basic level, annuity is a contract with an insurance company. You give them money today. In a lot of instances, you give them money today. There are all kinds of different annuities, but you give them money today. They promise you income for later, for a set period for your life, for however long it is. So the promise to pay is only as good as the insurance company's ability to keep it, and that depends on the performance of the investments and the health of the investment portfolio backing it. So this is why we bring it up, because it is something worth looking at. There are insurance companies who are more exposed to this scenario. There are insurance companies that are less exposed to this scenario. It's just worth knowing what position you sit in before you actually have to come time to start providing yourself income.
Yeah, and this is where people too, when you and we'll go into a little bit more detail because we're trying to dance on a tightrope here because there are some real concerns, and I've done the back testing using AI. I did the modeling, and it is a non-zero probability that lots of insurance companies that have made a lot of these promises with certain types of annuity products, people may not can get their money back. It is a non-zero probability. And a lot of people were sold these products thinking it was a zero probability. So there's a lot of variables. There's a lot of what ifs. There's a lot of nuance all built into what I just said. But that's the reality. But they're not bad products. For the right person in the right situation, a well-structured annuity contract can be a wonderful wealth building tool. We have seen it firsthand. Again, we don't have a lot, but we have a handful. We have a handful, a couple dozen people that use annuity products, and they have used them even before coming to us in a wonderful way. I have nothing against them. My personal preference and what most of our clients experience outside, and this is not dealing with variable, by the way. Anything we're talking about here has absolutely nothing to do with variable annuities. So just that's out the window. So this is anything that's not that. That's not a variable annuity.
Fixed or indexed.
Yeah, fixed or fixed index. Those products that I really like for the right person are the indexed annuities, which is the very simple way to think of it is you have a hedged call buying strategy without the risk. That's essentially what's occurring inside that product is you're letting the insurance company take on the complexity of buying call options on the index, and you're hedged on your downside. So you're not going to make as much as the market makes, but you can, we've had several periods of time where people have made 10, 11, or 12% on a product that doesn't go down in value. It doesn't happen all the time. Generally, I think our experience has been kind of expectations between that 6 to 8% is kind of the lifetime expectancy for those types of products. But it's essentially, I want the upside without the downside. The only real way you can do that is to have a hedged call buying strategy. And it's much less complex, much less costly, much less of a headache to let the insurance company do that for you. And they're great products for that. So we're not saying that they're bad, but we are saying that if you don't have a clear understanding of what type of annuity you're in and the type of company that's issued it, you could be in a situation where you think you're in a safe product that is not safe. And it's simply because some of these insurance companies have between 10 to 30% of their entire balance sheet backed by private debt, of which the overwhelming majority is issued by software companies that are getting their rear ends handed to them like no other industry in this country by artificial intelligence. And it's in real time. Like it's not like the Big Short or the Michael Berry thing where it's like it takes 6 years or whatever, 3 years or 2 years. It's happening in real time, and people need to be cautious and work with a professional in understanding if I am about to enter the annuity market, or maybe I have one, understand what you're in. Mm-hmm. And through that conversation, you may be validated and patted on the back and say, hey, keep doing exactly what you're doing. There's nothing wrong with it. In fact, it's probably the best thing for you to do. But you have to also have somebody review it and say, listen, this is what you're getting. These are the risks. So you just need to understand that you're not in a risk-free environment. And if you're okay with, what happens if the insurance company goes under and now it goes to the State Guarantee Association? Okay, well, what does that look like? How much money do I get back? Do I get back all? Am I not concerned? If I have less than a certain amount, it doesn't really matter. Those conversations can be had, but it's
all of it's public information. You can look at the public company filings. What are you looking for? In a real world example, what does somebody do with this information? What are they looking for? What questions should they ask?
Okay. I'm going to get this right because I'm going to get in trouble if I don't.
You have the Jeopardy theme music playing.
Well, I have a report I've done, but it doesn't give the specific.
Well, I mean, just off the top of your head, you want to look at what the investment portfolio looks like. That's number one. You're not just necessarily concerned about the rating of the insurance company. You want to actually know what the composition of the portfolio is.
Yeah. So, the simplest way to look at it, and you can use a Google search or an AI. I'm not going to pull everything up here. There's two different ways you look at it. One, you can look at the insurance company's balance sheet, but there's a special form they have to file with the states. and it's a quarterly form. And that particular form goes into a lot more detail. But you have to be able to understand each line item on the balance sheet to know which products fall into a category that is not marked to market. All right. And once you understand what is not marked to market, you can begin to go down the rabbit hole and see, okay, how much of this is non-marked to market private debt? And what's the par value they're stating it? And then run your what if calculations based on the commonly understood percentages of that category that would be exposed to SaaS related private debt. And then from there, you can back it out and say, this is how many annuity contracts they have. This is what they're promising to pay. What happens if they lose, half of this line item on their balance sheet? How does that affect their credit rating? Does that force them to have an injection of capital from somewhere else? Then what does it mean if the people that are listening to us say, let's say if out of 1,000 people, there's 100 of them that say, oh, I'm actually in one of those, I need to get out. And what if that happens at scale? Then it creates a run on the bank for the insurance company. Now they have a problem because they have to start getting capital to honor those surrenders. Where's it going to come from? They've already taken a hole in their balance sheet because the debt, they can't sell it. It's not worth anything. Now you get into a situation where you have caps on withdrawals, delays.
Which you're already seeing in private equity.
Oh, yes. You're already seeing that occur. Well, private debt, the private debt spot. Yeah, you're seeing caps on withdrawals. You're seeing Blue Owl Blue Owl having some problems, having to liquidate. I mean, they just liquidated their SpaceX private holdings at a valuation that's going to be half of what it is next year when SpaceX goes public. So that's a big deal. I mean, they're having to fire sell things. So it creates a lot of what ifs. And when you have that, knowledge is power, because you're able to say, work through those scenarios and say, hey, I'm good or I'm not. Because it's not every insurance company. It's just, it's the ones, if you've been marketed to on the internet or at a brokerage firm, chances are out of a list of 5 options, 3 of those 5 are ones that I personally would stay far and away from. Because if I'm going to assume the risk of a portfolio that has 30% illiquid private debt backed by software companies, why would I do it in the insurance? I at least want the upside. If it works out, why would I do it inside of an annuity contract? If I'm going to take that kind of risk.
Well, I don't think most people know. I think that's the whole point of this. Most people don't know it.
Yeah. I mean, you'd be better off. Well,
but the other side of that is not only knowing what the investment portfolio is within the insurance company itself, but also making sure that the rule of diversification that we talk about is not just meant to be diversification within a portfolio. It's a diversification of your assets as well. So if you have maybe more of your assets in an annuity environment, this is a conversation to have with somebody about, should I have this X amount in annuities? Should I diversify beyond that? All of those questions come into play. So it's a much wider conversation to have, but it's at least somewhere to start.
Yes, it is. And if you're a client of the firm that's listening, that we've talked about annuities, or maybe annuity plays an important role in your retirement, this is not for you. This is for people that have not had a vetted due diligence approach. And that's, I don't want to say it's an unreasonable expectation with brokers, because most of your brokers, the corporation they work for, call it a Wells Fargo, call it a Chase, call it whatever, they have these pre-vetted lists. And so the broker feels safe recommending it, and they don't know. They just know that.
We're not saying it's done with malice.
Yeah, they don't know. It's just like, hey, here's the list. This is what we do. And we've done it for 10 years, and the game keeps on going. With us, it's not like that. We have a big vetting process, and there are, again, some wonderful, great, intelligently ran traditional insurance companies that are fine making 0.5% or whatever it is a year on their product mix. They're perfectly fine with that cash cow. There's no bells or whistles. It is what it is, just like it was before 2008, when a lot of these companies started switching to this strategy. It's just like it was in 1995 or 1965. Nothing's changed. There's tons of those out there. Caveat is they're generally not the ones that pay the brokers the big commissions, which we don't get commissions. So,
yeah, I mean, the end of the result, and we're going to lose our cameras here, so we're going to have
and
to
my computer.
hurry this up.
I'm at a 5% battery life.
The end result is have the conversation, ask the right questions, talk about it if this is kind of concerning you. But 6 weeks of consecutive gains, record AI capital spending, a lot. We talked about this in this episode. We'll continue to watch it all, continue to look at it. That's been good returns. Thanks for spending time with us today. Good conversation, useful information, and we hope it leads to outcomes that are good for all of you. Subscribe if you haven't. Share with somebody who you think would benefit from this information, and we will see you back here next week.
Yeah, absolutely. Stay curious, ask questions. Kind of moral of the story here at the end, and everyone take care.
Yep, we'll see you later.